Credit card companies are falling in love with zero, home prices continue to rise, and we've got some Warren Buffett predictions. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I'm Matt Koppenheffer, joined as always by David Hanson. We've got a great show today. As I said, we've got some Warren Buffett predictions. We're going to continue reviewing our fantasy stock draft. This time we'll be looking at our round 3 picks, and we'll also be ranking 5 stocks that are trading below $10. But as always, we start with the headlines. David, our first headline here is an interesting one. We've got the Wall Street Journal talking a little bit about zero worship. The headline is Zero Worship. Credit card firms compete with no interest transfers. This is companies beckoning, the credit card companies beckoning you with those 0% balance transfers, but it may not be all that great. What's the deal here?
Yeah, so the credit card business can be a pretty profitable enterprise for these big banks, and the banks they're talking about in this article specifically doing this were JP Morgan, Discover Financial Services, and Citigroup. So we see all their credit card commercials. They're pretty heavily marketing their credit cards right now, and the reason they're doing that is not all banking businesses are doing great right now, but the credit card business is something that can thrive through many different environments. You can get the high interest on those balances that you do have. And you also get the swipe fees from when people just are at the grocery store, at the movie, swiping their credit card there. So you can get some multiple revenue streams from this. But by offering these 0% balance transfers, the downside is, and the article mentioned this, is that a lot of times they'll transfer that balance over, they'll get the 0%, but then they won't use the card anymore. So you're basically, they get the fee up front for the balance transfer, the JP Morgans of the world, the Citigroup, they get that fee. But then the cost to service that account, to have people on the phones, the infrastructure behind that, it ends up being a losing enterprise. So as a shareholder of JP Morgan, I don't know if I'm psyched about this. Yes, you get it's kind of short-term thinking, in my opinion, a little bit. Yes, you get the fee up front there, but you're also bringing over people that aren't the best customers in the world from a credit perspective if they are bringing over large balance transfers. So I don't know if it's something that I get very excited about.
I hear you, and I understand the concern, but I feel like if you're pulling somebody in that maybe is already a customer elsewhere in your business, I guess that's kind of one thing. But if you're pulling in somebody who's not a customer elsewhere in your business, so if I'm a customer of Wells Fargo and then JP Morgan draws me in with one of these balance transfer offers, and now I have an in at JP Morgan. So I have something that I have to log into. I mean, I'm assuming that I'm a customer using an online platform, which a lot are now. So now I have to log in to manage my JP Morgan account. Now it becomes just a little bit easier for JP Morgan to reach out, I think, and say, how about using some other Chase products? Because now they integrate with each other because you're on the same platform, basically. So I'm gonna side with, maybe this could work out. I'm sensitive to the fact that just like offering free checking accounts, the ultimate bottom line could be a cost to the bank that it's not making up with the operation. But I just like the credit card business so much right now compared to a lot of the other banking businesses. It's been a really good business. Now, continue to be done right would be the subhead that you have to keep on it. They have to do it right, and maybe this isn't doing it right. But I like the idea of the stronger credit card operators continuing to build the size and the scope of their business.
Fair enough. All right, moving on to our second headline. We're going straight to the source here. We're not using any Wall Street Journal for this. This is from S&P. Home prices continue climbing in June 2013, and this is Case-Shiller data. Year over year, numbers for June, home prices in the 20-city index up over 12%. This is great, right? Well,
I'm not gonna argue with it too much, but on the other hand, there are concerns here. You know, a lot of the increases in home prices have been driven by low inventory or tight inventory and not a lot of volume, as opposed to broad-based gains in the economy that are pushing up the housing sector. That's what I'd rather see. I think that's what any of us would rather see. So this helps banks. The higher housing prices will reduce the amount of loans that have to be charged off, because people will be less inclined to walk away from their homes if their home price is rising. This also helps actually some of the mortgage REITs that we talk about a lot of the times, particularly those that invest in non-agency mortgage-backed securities. Those non-agency mortgage-backed securities are not backed by Fannie Mae and Freddie Mac. So when you have an improving housing market, and again, housing prices help that, that'll help those kind of securities.
Yeah, I think it's certainly good news across the board. You mentioned the low inventory, not necessarily the economic growth that's really driving this, it's really more low inventory. The one thing that's not driving it, or we haven't seen evidence of it driving it, is shoddy underwriting and giving loans to people that shouldn't be out there. If you look at the Fed survey of loan officers out there, across the board, those limits in terms of who they give residential loans to, those aren't budging. They're not easing those standards very much at all. Easing some of the business lending, which could be a good thing. Maybe that was a little bit too tight, but we have not seen residential mortgage lending ease that much. So I think we can be fairly confident that the banks aren't out there writing shoddy mortgages, which we saw a couple years ago.
All right, we'll finish off the headlines with Bloomberg. The headline is eBay-style peer loans spur Wall Street asset craze. Peer-to-peer lending, David. This is the new craze. This is where it's going to be at. Are you excited about it? Are you lending peer-to-peer?
I'm not lending peer-to-peer. It is exciting. You look at it and say, okay, this is great for borrowers, easy access. You don't have to go through the banks, their tight standards, and then you also have the people giving the money, the lenders on the other side. You could get a nice interest rate that you can't get on your bank CD right now. But there is danger to this, and in the article they mention a company like Lending Club, or who has an investment from Google, I believe. Yes, they screen for the borrowers. They said they reject around 90% of people that are wanting to get loans. So they're rejecting a lot of people. But those 10% that are left, yes, they look like they're creditworthy on paper. All their metrics can look great, but you have to take into account the lenders on the other side, whether it's a hedge fund, a person in his basement doing these peer-to-peer lending things. When the competition heats up, and yes, they don't look quite as risky on paper, but if you don't price it right and you're not getting the right interest rate, then it's not a good deal. Then you can end up getting burned in the end, because it can look like a great investment, they can look creditworthy, but if the interest rate goes down so much where it doesn't make sense anymore, this could get into some trouble in the next couple of years, and that's the problem with it. It's going to take a couple of years to flesh out. I think they said by 2016 they estimate around $20 billion in loans on this platform, so it's still very, very small. So I'm cautiously optimistic about this, semi-pessimistic. I don't know. We'll see.
I think you're probably right. There will be major hiccups here. But listen, this is what I think about when I hear about stuff like this. The banks and folks who watch this show regularly know that I will typically go to bat for the banks just in terms of investment opportunity and that sort of thing, and operations and prospects going forward. However, there are a lot of people that are disenchanted with how the banks have been operating. And I think this represents yet another avenue for banks to be taken out of the picture in some fashion, you know? So consumers, when they have the option, when they need to borrow money, they can go to a bank, and these, like you said, these are the highest quality borrowers. These are a lot of the borrowers that banks should want to be wooing. Now they have another option. So there will probably be hiccups with this. There will be hiccups with a lot of the other non-bank financial services, because it's all very much developing outside of the banking world. But banks need to take note, and they need to think about customers are major stakeholders in this business. The investors certainly are stakeholders. The employees certainly are stakeholders. Customers are stakeholders too. Got to make sure you're treating them right so that they can come back.
I see it more as something that'll be more impactful 20 years from now. I think this certainly has to go through perhaps some boom and bust cycles, because yes, it looks great on paper, but the banks are not always the best loan writers and underwriters in terms of creditworthiness. But it's not something just the average Joe can do on a whim. Pick up the paper tomorrow and all of a sudden you're a great loan officer. So it takes time, but I do think it's viable in the long run.
Sure, but a good business does not wait 20 years till something is a major threat to address it. They address it today. Moving on, we had our fantasy stock draft. We've already gone through, you and I have reviewed our picks from the first and second rounds. Let's go to the round 3 here. As a review for our viewers in round 3, Billy, who's not here, who took part in the draft, he took Wells Fargo. You were the second pick in round 3. You took Goldman Sachs. I was the third pick. I took the mortgage REIT Two Harbors. And Brendan Matthews was the fourth pick, and he took Wisdom Tree, the fund company. David, why don't you give us some insight into why Goldman Sachs was a good third pick for you?
Goldman Sachs, the company everybody loves to hate. I look at the company, and let's just start from the business side first before we get into the numbers. I know you love the numbers. I look at Goldman Sachs, their business is almost number one in all of their businesses, whether it be actual fees earned or kind of just reputation, the qualitative aspects of the business. We look at their investment banking business, the merger and acquisition business, gold standard in investment banking there. We look at the markets business, fixed income trading, equities trading, investment management, and then also their investments on the side, which though that's kind of a cloud over the stock right now, is what are they going to have to unwind in terms of hedge fund activities, private equity activities, in terms of what the Volcker rule, which bans the banks from doing certain types of trading. Once that rule is set, what does Goldman Sachs have to exit? And they're not just sitting there and waiting to see what happens. They're actively exiting a lot of these businesses in a profitable way. So that's the business. I love the business there. But then when we look at the stock, so if we look at a price to tangible book basis, it's trading at about 1.1 times tangible book. Historically, the median, since it was public, is around 2.2. Okay, so you look at that and you say, okay, 50%. That's a lot cheaper than what it's been its entire history. But there's a reason for that. It's not so low for no reason. It's not just some glaring opportunity out there. So, and I actually have a graph here, if we can throw that up on the screen. So this is looking at the price to tangible book multiple. That's the axis on the right side there in the red line. And on the left side, we have debt to equity. So if we can just think of that as a rough, how much is the business leveraged? How much is the equity base leveraged? And you can see that these move pretty closely together, and which makes sense because you have returns on the asset, and then that's levered, and you get return on equity, which is really what equity investors are paying for in the long run. So yes, the price to tangible book is around half of where it's been in its entire history, but also the bank's leverage is about half where it's been in the past. So that's where it is now. My view for the next 5-10 years is Goldman Sachs is going to continue to perform. That leverage is going to slowly creep back up in a healthy way. We don't need to get back to 25, 30 times leverage, some of the investment banks were. But as leverage slowly creeps back up to a healthy standard there, we get more dividends, we get more buybacks. I look at this, and at 1.1 times tangible book, even at the lower leverage levels, I think over the long run, it's going to be hard to lose with Goldman Sachs.
That seems short-sighted to me. Not what you're saying, but I understand, and I like that graph, and I understand where investors would be coming from if they're just looking at the end result of return on equity. And like you said, the leverage impacts that. But everything else that leads to that return on equity, the core business operations, the core earnings power, that's there, and that's producing everything else. The leverage is something that you can, again, we'll have to watch what happens with regulation, because regulation will impact the amount that Goldman can lever itself. But the leverage is something you can play around with. You can bring it down when you need to be more defensive. You can crank it back up when you want to take advantage of things. So it seems short-sighted to think that everything else may still be there at Goldman Sachs, and then just that leverage ratio is down just a little bit now. So that is pretty interesting.
The other couple numbers I'll throw at you is share count. So we think about the financial crisis and the financial companies that really got into trouble, that really hurt shareholders. A lot of it was because of share dilution. So I'll give you some numbers here. Since 2007, Goldman Sachs share count is up 6%. Okay, so still up, but when we look at Morgan Stanley since 2007, share count up 77%. When we look at Bank of America, share count since 2007 up 142%. So when we just look at it from a dilution basis, Goldman Sachs shareholders did not get that diluted during the financial crisis. And since the end of 2010, share count has come down 15%. So they're actively trying to get that dilution back. They're working for shareholders, and I believe in the management there.
Okay, turning to Two Harbors, you had mentioned before that I like numbers, and I do like numbers. But when it comes to the mortgage REITs, the reason I don't like the mortgage REIT business in general is if you think about Visa, for instance, as a company, Visa has created something. It's created a payment network. It's created a brand. And that endures. I can think about a year from now, I know basically what Visa's business will be doing because I understand the core business it's created, the customer brand loyalty that the company has created. In the mortgage REIT business, they're funds, basically. They're funds, and so it's very similar to investing in a mutual fund. And so you're reliant very much not on some product or service that's been created, but rather the people that are running this business and managing the funds. And we've said that before, but I think it's so important that these aren't companies that have built something that's enduring. If the people change 6 months from now, if the CIO, the chief executive officer, if those change over, it could be a whole different picture. So anyway, with that in mind, what I really like about Two Harbors is that it's a very well managed mortgage REIT. There's a quality hedge fund, a very large quality hedge fund, Pine River Capital Management, behind Two Harbors. This is managed by Pine River. Two Harbors is. The portfolio is diversified. This is different than many of the other major mortgage REITs. So if we look at Annaly Capital, if we look at American Capital Agency, now Annaly, in its investment criteria, it can go outside of the agency-backed mortgage-backed securities. And again, the agency-backed, those are backed by Fannie Mae, Freddie Mac. That takes away some of the default risk in a mortgage-backed security. Annaly can go outside that to a small extent in its portfolio. It hasn't really done much of that. Two Harbors relies on that. So they're very nimble in terms of what they can invest in, and that allows them, they call themselves relative value investors, which basically means is that they're looking across the whole mortgage sector basically and looking for where the relative values are, where stuff looks attractive versus everything else. Whereas if you're focused on agency mortgage-backed securities, guess what you're buying? Agency mortgage-backed securities. You can. There's a little room for strategy and going back and forth, and we've seen that at Annaly and American Capital Agency. But there's far more. Two Harbors has far more opportunity to do that. Two Harbors has also been taking advantage of opportunities outside of just straight mortgage-backed securities. They're looking at buying. They're starting a mortgage servicing rights platform, and they've been buying some mortgage servicing rights, and they're looking to do even more of that later this year. They've done a securitization. They're looking to do more securitization, so they're taking on straight mortgage loans and they're securitizing those. They're buying credit-sensitive loans, which are basically kind of distressed loans, so they're getting a little opportunistic. And I think a good illustration of the way that they've taken advantage of various opportunities is Two Harbors was buying up a bunch of single-family homes to rent back out, very similar to what Blackstone was doing. Right. So they bought a whole bunch of that, and then they spun it off as a whole nother company, Silver Bay Realty Trust. So that's a great example of when they saw an opportunity, they went for it, they did it, and then they created a whole nother company out of it. So I really like that. And then the final thing that kind of wraps this all together is if you go to Two Harbors' investor relations page, if you read the company's SEC filings, you really get the sense that they want to offer all of the information that investors need. They really want investors to understand what's going on, understand what they're doing. And I think that's great, and I think that's the sign of a management team and an investment team that knows what they're doing and wants to make sure that they're on the same page as the people that are investing in the fund. So I'm not the biggest fan of the mortgage REIT business as companies. As funds, it's a different story. But when I look out over the landscape, Two Harbors is definitely one of my favorites, and I'm happy to have that as part of my fantasy.
I think it's kind of like their investment policy. It's all relative in the landscape of mortgage REITs. Relative to the others, you like them the best.
Exactly. So moving on from our fantasy draft to something a little bit similar, we're going to play a little rank it. We've got 5 companies here, 5 stocks. So we were talking about it, and we were going to rank all of the stocks that have a stock price of $165,000 or more, but we could actually only find one of them. Yeah, so that wouldn't have been much of a ranking. But we do have 5 stocks, 5 financial stocks that are trading below $10. Now, I should point out
arbitrary.
Stock price, it's very arbitrary. Stock price is not meaningful. So whether you're Berkshire Hathaway trading above $165,000 for those A shares, or you're one of these trading below $10, it's all relative to how many shares you have out and everything like that. But just to be arbitrary, we're using $10 here.
Right.
So the five stocks that we have here are Synovus, Synovus the bank, Chimera, which is one of those mortgage REITs, MGIC, which is a mortgage insurance company, Regions Financial, another bank, and Huntington Bank shares, one more bank. Let's start off. Who is the first on your list? Which of these companies?
Alrighty. Well, we got the graphic here. We'll throw up all 5 of my rankings off the bat here. My first one I have is Regions Financial there. Regions, it's a regional bank, if you would have guessed it. They focus in the southeast part of the United States, Alabama, Florida, Georgia. Didn't have the best time during the housing crisis. Really got hit hard there.
That was a rough area to be in.
The thing is, they're not fully a mortgage lender either. They do have mortgage loans on their books. So that hurt them to an extent, but it was really just the economic downturn in that area. They're much more of a commercial lender, commercial business loans and also commercial real estate. So it's a little bit of a turnaround story, trying to just get the balance sheet back to a strong position. And they're making progress. And if we look at charge-off, so how much of the loans that they're deeming that they're not going to collect, that's down about 50% since last year. So they're definitely making progress with the quality of their portfolio. And we look at, do they have the capacity to make new loans, to make better loans? Their loan to deposits, so how many loans they have outstanding to the deposits on their books, it's around 80%. Historically, it's trended for them around 100%. So they do have the capacity to go out there and make more loans. And when I couple that with the valuation just over 1 times tangible book, below book value, I think the long-term earnings power is still there for Regions, so that's why I'm ranking it number 1.
Alrighty, so my number 1, we can take a look at my entire list here, and you'll see my number 1 is Huntington Bank shares. What it doesn't have versus your number 1 of Regions, the valuation isn't quite as attractive, but I still think it's a pretty attractive valuation currently. What I really like about Huntington is I like its leadership. I think the CEO is really solid, and I think what comes out of that is a broad strategy, and part of that strategy is we talked about, or I talked about earlier in this episode, the banks needing to attract customers, thinking about customers as stakeholders, and I think Huntington does that really well. They have a product called Asterisk Free Checking, which is basically free checking, no ifs, ands, or buts. And we've seen a lot of banks move away from free checking, and there's good reason for some to do that. But if you can attract customers with free checking and make it work for you, I think you make customers happy. You potentially get new customers in that'll be customers for life. So I like that. Huntington also has what they call the 24-hour grace product, which is if you overdraw your account, the bane of many customers' existence. If you overdraw your account, they'll give you 24 hours to get money in there, and they won't charge you a fee, which is great. Get the customers happy. And they've also, in terms of distribution, you and I talk a lot about online banking and mobile banking and how that's great for banks, and it is, and Huntington does that. But at the same time, they're thinking outside of the typical branch in order of reaching its customers and being in convenience. And so they've opened up branches in a lot of grocery stores that gives customers an easy way to interact with the bank. So I think Huntington just does so many smart things, and it shows through on the bottom line too. Returns on equity have been very good. So I think valuation plus solid operations, it's my solid number 1.
I wrestled between those two, and I look at them, and they're very similar in kind of their business strategies in terms of skewing to commercial lending there. I thought about it, but when I looked at the long-term earnings potential, I gave the nudge to Regions, but I'm not calling you crazy for putting things in there.
It wouldn't be the first time.
Huntington was my number 2, and we'll hop down to my number 3, Synovus Financial. When we talk about regional banks, this is even smaller than Regions and Huntington Bank shares further down the line there. They got into some trouble in terms of the assets on their books, the loans on their books. Not a pretty sight, stayed unprofitable a lot longer than most banks, most regional banks did after the recovery. But like these other 2 regional banks, they're slowly turning the corner, and it's a process. And I think there's opportunity there just by investors not wanting to stick around and wait for that process to fully come to fruition. When we think about the housing recovery, just the broader economic recovery. Yes, the U.S. is not growing at 4% a year. But for Synovus, it doesn't necessarily need to grow at 4%. They just need to clean up the balance sheet.
Sure.
That's what they're doing. The long term, very long term for Synovus is to get back on their feet, have a solid balance sheet. I think they're doing it. It's not going to be an overnight story, but I think there is potential there for Synovus.
So my first two were flip flop, just like yours. So I had Huntington and then Regions, and then my number 3 was Chimera. And I just finished talking about how I don't really like the mortgage REIT business in general. I'd rather invest in a different business. I'll put it that way. Maybe it's not so much that I don't like it. I'd rather invest in different types of businesses. Chimera is a funny situation because it's gone through a lot of
interesting things.
A lot of interesting things. They had some accounting snafus for a while. The company wasn't up to date filing its filings with the SEC,
and it's still not.
No. It's and as our colleague John Maxfield likes to point out, there's a relationship. This is sort of the sister company to Annaly Capital, and it's managed by the same investment committee that manages Annaly.
Right.
And as our colleague John Maxfield likes to point out, there's a little bit of funniness in that the CFO of Chimera, which is going through all these accounting issues, is the sister of the CIO and CEO.
Right. I think former. I think she is left now, the CFO of Chimera. But it was during the accounting problems.
During the accounting problems, yeah. And so you've got a little bit of funniness there. But at the same time, if I look at the mortgage REIT sector, Annaly, I think, is one of the better managed from an investment perspective. And Chimera is the sister company. And when I dug in and actually looked at the accounting issues that were keeping Chimera from keeping up to date on its filings, it's never ideal. Let's say it's never ideal to go through that, but it didn't seem to me that they were doing something untoward. I think that there was just a misunderstanding on complex issues having to do with mortgage REITs. So I think that there's opportunity once that all gets cleaned up and moving forward. And this is when I was talking earlier today about agency versus non-agency mortgage-backed securities. This is primarily non-agency. This is non-agency mortgage-backed securities. So I think maybe there's a little bit more opportunity for some searching for relative value in Chimera. So I think that there's good upside here. So that's why I'm giving Chimera the nod at number 3.
I had them at number 4. It's just
it's hard. It's a distasteful number.
The last 10Q they filed was recently, but it was for last year. It's for 2012. So they're still. But they are
getting there.
They are providing updates in terms of kind of off 10Q, off the record. What do we think book value is right now? Right. They came out with that just a couple weeks ago, and the stock's trading at about an 80% discount to what they said the book value is. So it's not insanely cheap when we think about where the mortgage REITs are today in terms of a lot of them selling at a 20% discount. So,
but you're seeing a lot of that on the agency mortgage back.
They do have agency as well there. It's non-agency.
Right, but
so it's a balance. So yeah, I had it at number 4. It's not something, I don't know if I would sleep well at night. I think there's certainly opportunity there. I'm a shareholder in Annaly, so it's not like I think this management team doesn't know what they're doing. But when I looked at the list here, I thought there were just better opportunities at the ones I ranked ahead of it.
Just got to hold your nose just a little bit. Moving down to my number 4 was Synovus, and similar where it probably could have flip-flopped. I mean, when you look at this list that we had here, it's not exactly shining.
It's not a beauty contest.
It's not shining examples of the best-run financial companies that are available. So Synovus at number 4, I share a lot of your views on that. I think that the valuation gives some opportunity for the future. Moving down to my number 5 is MGIC. This is a mortgage insurer, the largest mortgage insurer, in fact. I just can't get on board. I have so much trouble getting on board with this business. It's not just because of the financial crisis. It's somewhat because of the financial crisis. But when I look ahead and I think about the products that financial service companies offer, so on the insurance side, life insurance and auto insurance, I feel like these are necessary products. The mortgage insurance, it's insuring mortgages where people are not putting down enough of a down payment. and promising to make up the difference to banks. And I don't know, there's still a place for it, but it's just not a business that I can get excited about and think, oh yeah, this has a really great future ahead of it, where people are not going to be putting down big down payments on their mortgages. So I don't know, from a business perspective, I'm just not excited about MGIC.
Yeah, I'm with you. When you look at it, it's a very hard business to price the risk correctly. And obviously we saw that with the financial crisis. And it's easy to blame them for being so bad after the financial crisis and still unprofitable to this day, even 5 years after, or they've been unprofitable for most of their quarters here. It's just a hard business to price the risk correctly, because in good times, when mortgage lending is out there, maybe you get a little bit lax. Oh, they're giving loans. The pricing it's just like you said. It's a hard business to get your head around.
But it's a hard business to get your head around insuring catastrophes.
Right.
This is the same thing.
Yeah, it's not something that I would necessarily want to hold for the next 5-10 years. I don't know where the industry's going. I think there's certainly a space for this business. There's always going to be people that want to get loans. The banks just can't give it to them without that insurance there.
And the valuation and the direction of the financial industry and the economy may be primed for MGIC to continue to bounce back. But yeah, it's just not a business that I'm excited about owning. And at the end of the day, what I'm looking for are businesses that I want to own. I will be opportunistic sometimes and maybe hold my nose a little bit. You know, I think about a Chimera, for instance, which I won't actually buy. But yeah, at the end of the day, I want a business that I want to own for a long period of time, and MGIC just isn't it.
I agree.
Finishing off, as we always do, on the Twitter sphere, David, why don't you give us the first tweet?
First tweet, talking housing again. We got it from Marketplace Tech Report at Marketplace Tech. Buying a house, there's an app for that.
There is.
I guess there is.
And there are.
Are you buying a house?
There are a lot of them. I am not buying a house. But if I did, let me think about it. If I were buying a house, I would definitely go to tech resources. I don't know if I'd necessarily be going mobile. I'd probably be going online. And I'm not sure. Yeah, I probably would be. I'd probably be using either your favorite company, Zillow, or its prime competitor, Trulia. The tweet here is referring to the fact that there are a lot of different mobile apps out there and it's not just for people buying homes, it's also for people going out there and renting, from Zillow, from Trulia. It's a changing marketplace, and they're taking advantage of all the different avenues. I think most people probably still think of Zillow and Trulia as online resources. But as we've seen in banking, a lot of people are moving to the mobile banking in addition to using the online banking. And so there's no reason why the same isn't going to be true with the real estate transformation.
Yeah, I mean, you mentioned Zillow and Trulia. They're loving the whole shift to mobile there. They do better on mobile. You look at Zillow, and their CEO has come out, Spencer Askoff, and said, look, we do better on mobile. We're getting more views. That rate is increasing a lot faster than what people are going on desktop. And it's interesting too, especially on the weekends, they see a huge spike in mobile traffic because you're driving around looking for houses. You can look up where you are, location-based. And they do better monetizing in terms of people actually clicking through and contacting a real estate agent, which is what their business is. A lot of people think about, I don't even know what Zillow does. What are they, just an online platform? They do have advertising.
There's Zestimator.
Yeah, exactly.
Online Zestimator.
They do have advertising, which they make a small portion of their revenue, but they're a subscription business to real estate agents out there. They get on their platform, and when people drive around and see the houses that the real estate agents are agents for, they can contact them. So they're really a service provider through those subscription services. So yeah, they're loving the shift to mobile. When we step back and look at Zillow from a stock perspective and Trulia from a stock perspective, yes, I'm a shareholder in Zillow. Do I think it looks very expensive today? Yes, I do. I think there'll be other opportunities to potentially get in later at lower prices. I'm not going to freak out if the stock drops 20%. This is a growth stock. Both of them are. So if you're buying either of these today, if you believe in the long-term vision, great. But be ready for these to be a little bit of a rocky ride. It's not going to be like this. It's going to be a rocky ride, and I'm holding on for now. But it's definitely an interesting industry to watch.
Our second tweet comes from Ben Walsh. His Twitter handle is at Ben D. Walsh. And the tweet reads, builder of Hampton's McMansions credits the Fed for his booming business. He links to a New York Times article, David, and that article reads, but most of all, he credits the Federal Reserve for the economic stimulus. This is referring to this home builder in the Hamptons, which he said has helped the wealthy most of all. He says, the stock market's flying through the roof, and who's that helping? The middle class? No. I mean, that's the reality, he said. Out here, life goes on. David, the Fed is only helping the 1%, right?
I don't know, only the 1%. I mean, I think they've helped all of our portfolios. I don't think there's any denying that quantitative easing has helped the stock market to some extent. So I don't think I'm the 1%. But it's certainly, the sad thing is it's certainly not helping everybody, because our colleague Morgan Housel has looked at the households and who owns stocks in the US, and it's a very, very, very high concentration at that top percentiles in terms of who owns stocks. So sadly, the middle class family, either they're not saving enough for retirement, they don't believe in the stock market, that they've kind of been scorned by it since the financial crisis. So unfortunately, a lot of them are not invested. So it's hard for me to disagree with what he said there.
I find it a little bit easier to disagree, but here's the thing. In particular, what you said, middle class, particularly middle class investors avoiding the stock market, looking at what happened during the financial crisis and saying, oh, it's rigged, I shouldn't even bother investing in the stock market. That is wrong-headed thinking. That is, the stock market is driven by psychology. It always has. And we get these big boom and bust cycles. And it's difficult. It's a psychological game to be sure, but it's really easy. Yeah, I mean, even for the run-of-the-mill average person, I won't even say investor, person, to be invested in the stock market, get an index fund with low fees, and just stick with it. And if the rising stock market is not helping the middle class, that's a sad, sad thing, because the middle class has opportunity to be in the stock market and be in the stock market in an easy and low-cost way that hasn't been around for all that long of a period of time. So
right.
It's a sad commentary if that really is the truth.
I'll step back from my hard position that it's not helping the middle class a little bit. What you said there, the stock market necessarily isn't helping the middle class, and I'd potentially agree with that. But quantitative easing, he's talking about McMansions in the Hamptons for this. Quantitative easing, the purpose of it, one of the purposes was to drive down long-term mortgage rates, to really spur the housing market, which it's done. So even if you're not someone that was selling a house and making a profit on it, if you just had a house and say you were underwater, a middle-class family underwater, and your housing prices have just risen a little bit and you're not underwater anymore, that certainly benefits them. So maybe they're not benefiting directly from the S&P being at higher. You convinced me. Uncle Ben's helping everyone. Bernanke's, he's got his tentacles out there and he's helping most people. All right, the last tweet we got from some company called the Motley Fool, at.the Motley Fool. Warren Buffett wipes spilled cherry Coke off his crystal ball, divines 3 predictions for the rest of 2013. Matt, what are your predictions around Warren Buffett?
This is an article from our colleague Steve Symington. He had some interesting predictions for the rest of 2013. My Warren Buffett prediction for the rest of 2013, this won't surprise people that read an article I had on the Fool site last week, that in the most recent 13F filing from Berkshire Hathaway, there's an interesting line in there which basically said that they've excluded some information from the public filing that they've filed with the SEC. That may all sound like gobbledygook, but basically what it means is I believe that later this year, we're going to get an announcement from Buffett and Berkshire Hathaway that Berkshire Hathaway has built another large position in a stock similar to what it did with IBM. So that's my big Buffett prediction for the rest of 2013. David, take us out with yours. Oh,
I'll go with that. He's going to make another fairly large acquisition, again using some debt to finance it. So the last one we saw was with Heinz, with 3G. They got a little bit of a sweetheart deal there in terms of getting a preferred dividend, 9% every year, but there was debt used in the deal. I think we could see that again, just because interest rates are starting to tick up. And I think when 3G kind of put that deal together with Buffett, I think that probably set off the light for a lot of people saying, I need to try to get a deal with Buffett. I think there's the chances of one coming across his desk that really just makes sense. If someone maybe just reaching and giving him more of a sweetheart deal than he even deserves.
It's kind of a career maker doing a deal with Warren Buffett.
Right, and I think someone could be like, we'll give him that preferred, the preferred even if it means him just being in half of the deal like Heinz. I think the chances of that have to be fairly high that someone out there is going to reach out to Buffett and try to get something moving again. So by the end of 2013, I'm sure we'll see something big.
Interesting call. Well, again, folks, I'm Matt Koppenheffer with David Hanson here. And my final prediction for the day is that we will be back here again tomorrow. Thanks for watching.